We like to think our financial choices are, driven by pure logic, careful calculations.
Right. Cold, hard facts.
But what if our deepest emotions, our hidden biases, are the real architects, often without us even realizing it?
It's a fascinating thought, isn't it? And that's exactly the realm of behavioral finance. It's all about understanding how our psychological quirks influence our money decisions.
Often in ways that traditional economics just kind of misses.
Exactly.
And that's precisely where we're headed today. This deep dive is all about those hidden forces shaping how we invest. We've gathered some really insightful stuff, articles like 5 behavioral biases that can impact your investing decisions, another one on overcoming biases.
Oh, and insights from that big book, The Psychology of Money, right?
Yes, exactly. Reviews and summaries of that, too.
So the goal is really to unpack some of the usual suspects, like
Yeah.
overconfidence, herd mentality.
Yeah, loss aversion, that fear of losing anchoring, confirmation bias.
And not just what they are, but, how to actually deal with them.
Exactly. We want to give you practical strategies. Think of it as a shortcut, maybe, to understanding the why behind some investment moves.
And hopefully how to make smarter ones. Avoid those common pitfalls.
Right. And it's interesting, isn't it, how even financial planning, which you might think is all numbers,
Yeah, purely analytical.
is really starting to recognize how huge this psychological side is. That integrating behavioral finance piece mentioned it.
Absolutely. Understanding the human element is becoming, crucial for good advice.
Okay, let's dive in then, starting with one I think many of us might recognize, overconfidence bias. What's really going on there?
Well, at its core, it's just overestimating our own skills, our judgment.
In investing, that means thinking we're maybe smarter about the market than we are.
Yeah, or better at picking stocks than reality suggests. And that can lead to, taking on too much risk or maybe making quick decisions without enough info.
It reminds me of that statistic, about driving, where almost everyone thinks they're an above-average driver.
Exactly. That's a perfect everyday example. It's statistically impossible, but we feel it.
And that happens in investing, too.
Oh, definitely. Research, I think FINRA did some, shows a big chunk of investors, maybe 64%, believe they have a high level of investment knowledge.
Wow. So a lot of confidence there.
Yeah, and while some definitely are knowledgeable, that widespread self-assessment can be, inflated. It feeds into that overconfident behavior.
Does all the information online make it worse, maybe? Like you Google a stock, feel like you understand it?
That's a really good point. The sheer ease of access can create this illusion of expertise.
A false sense of knowing it all.
Right. You do some quick research, feel empowered, maybe start trading actively.
Based on feeling like an expert when maybe you just scratched the surface.
Exactly. And the track record often doesn't back it up, does it?
No, I saw that stat, something like only a quarter of actively managed funds beat the market over 10 years recently.
Right. So there's a big gap between thinking you can beat the market and actually doing it consistently.
Which really underlines how tough it is.
It does. So the big question for us as investors is, how do we keep that confidence in check? How do we get more realistic?
Well, the sources had a couple of ideas. One was pretty straightforward.
Yeah.
Talk to a financial advisor.
Yeah.
Get that objective view.
Makes sense. What was the other one? Something a bit different.
Yeah, the pre-mortem exercise. That's interesting.
Ah, yes. That's a great technique. You basically imagine fast-forwarding, say, 10 years.
Okay.
And assume your current strategy has totally failed, like spectacularly.
Oh, okay.
Then you work backward. Why did it fail? Brainstorm all the possible reasons.
So you're looking for the flaws before they happen.
Exactly. It forces you to challenge your own optimistic assumptions. It tempers that overconfidence.
That's clever. Proactive pessimism almost.
Yeah.
Okay, let's shift gears. What about herd mentality? Following the crowd.
Right. Herd mentality in investing. It's
Yeah.
pretty much making decisions because everyone else is doing it.
Not because you've done your own homework.
Precisely. It's often driven by FOMO, fear of missing out. That pushes us to follow trends, even if they don't fit our own goals or risk tolerance.
And it doesn't take much to start a stampede, right?
Right.
I read somewhere that just a few influential people can sway a huge majority.
That's right. Just 5% of informed investors, the research suggests, can influence the other 95%.
Wow, only 5%.
Yeah. Or even just a lot of media hype around something. It creates this cascade effect. People jump in without really thinking it through.
And that's how we get market bubbles.
It's a major factor, yeah. Prices get detached from reality. And it works on the way down to panic selling just because others are selling.
So the lesson is, if everyone's suddenly talking about a hot stock, maybe pause.
Definitely pause. Go back to your own plan. That's the key defense. Having a solid, well-thought-out strategy.
Based on actual data, your own risk level.
Exactly. And diversification helps too, right? Spreading your bets cushions the blow if one thing goes crazy because of the herd.
And having an exit plan before things get emotional.
Crucial. Knowing when you'll sell beforehand stops you from panic selling when the market dips.
And again, a good advisor could be a steady hand here.
Absolutely. They can help you stick to the facts, stick to your plan, and resist that emotional pull of the crowd.
Okay, next up, loss aversion. This one feels really primal. Losing money just hurts. More than winning feels good.
It really does. Loss aversion is exactly that the pain of a loss feels way stronger psychologically than the pleasure of an equivalent gain.
And how does that mess with our investments?
Well, the most common way is holding on to losing investments for way too long.
Because selling means admitting the loss, making it real.
Precisely. The thought of locking in that loss is so painful we avoid it, even if, logically, we should cut our losses and put the money somewhere better.
Like that real estate example in the sources. Holding a property that's losing money month after month.
Yeah, because selling it for less than you paid just feels awful, even though keeping it is costing you more.
So the emotional pain outweighs the financial logic.
Often, yes. So how do investors fight this? What helps?
Well, again, those pre-planned exit strategies seem key. Knowing your sell point beforehand.
Takes the emotion out of the decision later.
And also focusing on the current value and future potential, not the price you paid way back when. Trying to detach from that original cost.
Right. Regular portfolio reviews help with that. They force you to look at things objectively based on today's market, not history or emotional attachment.
And advisors recommend setting clear buy-sell rules.
Yeah, clear criteria, and always focusing on your overall financial picture, your long-term goals, not getting hung up on just one investment's performance.
Okay, moving to anchoring bias. This is about getting stuck on the first piece of information, right?
Exactly. We give that initial info way too much weight. It becomes an anchor that pulls all our later judgments towards it, even if new data comes along.
So if I first hear a stock is going to the moon, even if later reports are like, well, actually, I might still have that initial optimism coloring my view.
That's it, perfectly. You've anchored to that first positive forecast. It makes it harder to objectively process the new, maybe negative information.
And this gets tricky when markets fluctuate.
Very tricky. People cling to old reference points like a past high price and don't adjust to the new reality.
So how do we, lift the anchor?
You have to consciously work at it. Keep refreshing your perspective.
Like constantly check against current market data.
Yes, regular reviews against current benchmarks are vital. And don't rely on just one indicator or that first news report. Use multiple sources, multiple metrics.
Look at the bigger picture, market trends, what others are doing.
Right. Develop objective evaluation criteria. Always focus on now, on current conditions, not just that initial impression or past glory.
Makes sense. It's about staying current, not getting stuck in the past. Okay, let's tackle confirmation bias. This one feels sneaky because, well, we like being right.
It is sneaky and powerful. Confirmation bias is basically our tendency to actively look for information that confirms what we already believe.
And we ignore or dismiss anything that contradicts it.
Pretty much. So if you think, say, tech stocks are the future, you'll notice and remember all the positive news about tech.
And kind of filter out the warnings or the arguments against it.
Exactly. It creates this comfortable feedback loop. Your beliefs get constantly reinforced, so you feel less need to question them.
It feels good, but it creates blind spots.
Huge blind spots. You can miss risks, miss other opportunities, just because you're stuck in your own echo chamber.
And it's probably worse during crises, when things are changing fast.
Definitely. Instead of seeking objective analysis to adapt, people might double down, looking only for info that justifies their existing, maybe failing, strategy.
So breaking free means what? Actively looking for the counterargument.
Yes, that's key. Deliberately seek out opposing views. Challenge your own assumptions. Why do you believe this trend will continue? What could go wrong?
Do thorough research, including the other side.
Absolutely. Ask open-ended questions, not just ones looking for a yes. And crucially, regularly check your performance against objective benchmarks. Does the data actually support your belief, even if it's uncomfortable?
It really drives home that managing ourselves, our psychology, is as vital as the finance stuff.
It really is.
And that brings us nicely to The Psychology of Money by Morgan Housel. That book really hammers this point, doesn't it?
Oh, absolutely. Housel's core argument is that financial success is way less about how smart you are, your IQ or technical skills.
And much more about how you behave. It's
Exactly.
achievable.
Mastering your
And
own
these
behavior, your
principles,
emotions,
even though they're wrapped
understanding
in
these
stories from
biases, those are the
Babylon,
real keys
they're
to
still
building wealth
incredibly
over the long
practical
haul.
for us
He uses
today,
those
aren't they?
amazing stories,
Absolutely.
right? Like
The
Ronald
context
Reed, the
changes,
janitor
the
who died
tools
with
change,
millions.
maybe
Yeah,
the
contrasted with the
percentages need
high-flying
tweaking,
finance
But
exec
the
who went
fundamental
broke.
habits
just
of
shows
financial
it's not
health,
just
they
earnings.
seem pretty
It's
universal.
habits.
Enduring.
So it's worth
Patience.
everyone taking a moment maybe
Precisely.
to think, which
Which
of
of
these
these all about
resonates most
consistency?
right now? Which one
Saving
could I start
steadily,
applying?
even in a
Investing
small
patiently
way.
in good companies
That's the perfect way to think about it.
decades,
Small
even on a
steps,
modest
taken
income.
consistently.
The
So
executive
let's
shows
leave
high
everyone
income
with
means
this thought.
nothing without the right behavior.
Considering
And
these
House
ancient
stresses
insights,
just being
What's
pretty
just
good
one
consistently,
small
right?
seed
Not
you can
chasing
plant
huge wins.
starting today
yeah,
that will
avoiding
begin
big
to grow
mistakes
your
and letting
own tree of
compounding
wealth?
do its
Yeah,
work
give
over
that
a
some
long
real
time is
thought.
more important than
And
trying to hit home
definitely,
runs.
if this
He also
sparked your
talks about
interest, check
survival,
out the
doesn't he?
full book,
Being
The Richest
financially
Man in
unbreakable.
Babylon, and
Yes.
keep exploring
It's
these
not about
ideas.
pessimism,
Thanks
but
for joining us on the
resilience.
deep dive. Being able to
Thanks for the chat.
withstand the inevitable downturns, the unexpected life stuff, so you can stay invested and let compounding work its magic. Longevity is key.
And the power of time itself. Using Warren Buffett as the example. Starting so young.
Right. Buffett started investing seriously around age 10, and most of his wealth came after he was like 65.
Wow. That really shows the compounding effect over decades.
It's staggering. It's not just smart picks, it's the time those picks had to grow.
I so liked his point about enough, knowing when to stop chasing more.
Yeah, that's countercultural, isn't it? He argues true wealth is gaining control over your time, your life, not just buying more fancy stuff.
Avoiding the moving goalposts.
Exactly. Where you hit a target, then immediately set a higher one so you never feel content. His own family's approach is illustrative, prioritizing independence, saving a lot, simple index funds.
Not trying to keep up with the Joneses.
Right. It's about defining your own goals, what matters to you, and building a strategy around that.
And it seems like that message really clicked with a lot of people, especially online communities focused on long-term investing.
Definitely. The idea that behavior trumps brilliance really resonates.
So this growing awareness, it's changing financial planning itself. The profession is adapting.
It really is. It's moving beyond just the numbers, while the standard process gathering data, setting goals is still there.
The CFP board process, yeah.
Right. There's much more focus now on the emotional, the behavioral side, understanding the person behind the finances.
And that's where fields like behavioral finance, financial psychology, financial therapy come in, bridging that gap.
Exactly. Behavioral finance gives us the why of the biases. Financial psychology applies that, plus other psychology, to help clients.
And financial therapy is even broader, looking at the whole picture, emotional, relational, financial well-being.
Yeah, it's very holistic, helping people have a healthier relationship with money and life.
So how does this play out in actual client meetings? Planners are doing things differently?
They are. There's more emphasis on building rapport, really listening not just to the numbers, but the anxieties, the beliefs about money.
Using techniques like motivational interviewing.
Yes. Asking open-ended questions, affirming strengths, helping clients find their own motivation to follow the plan rather than just being told what to do.
And I read about tools they use now to understand those deeper money beliefs.
Right. Things like the Klontz Money Script Inventory, the KMSI. It helps uncover those subconscious scripts like whether you avoid money, worship it, see it as status.
Knowing that helps tailor the advice.
Hugely. You can address potential roadblocks. And other scales measure financial health, anxiety, giving a fuller picture than just the spreadsheet.
And it's not just about understanding, but getting clients to actually do things.
Absolutely. Using homework, small tasks, or experiments between meetings helps turn talk into action.
Overcoming that inertia, the status quo bias.
Exactly. Gently guiding clients past the tendency to just stick with what they know, even if it's not optimal.
And these insights help with ongoing management, too, like navigating market swings.
Definitely. Understanding things like the disposition effect, selling winners too soon, holding losers too long, lets planners coach clients through those impulses.
Or herd mentality during booms and busts.
Right. Proactively educating clients about these traps helps them stay the course. Same with confirmation bias, encouraging them to look beyond the headlines that just confirm what they already think.
Okay, so let's pull it all together. For individuals listening, what are the key takeaways, the main strategies to fight these biases?
Well, boiling it down from everything we've discussed, first, just awareness. Recognizing when bias might be creeping in. That's step one.
Okay, awareness.
Second, goal setting. Having clear, smart goals, specific, measurable, achievable, relevant, time-bound. That keeps you grounded in logic.
Right. Gives you something concrete to aim for.
Third, seeking professional advice. Getting that objective viewpoint from an advisor is invaluable.
Takes your own emotion out of it a bit.
Fourth, mindset matters. Cultivating emotional awareness, managing financial stress. Fifth, ongoing financial education. Keep learning, stay updated.
Build that literacy.
And finally, diversification. Don't put all your eggs in one basket. It limits the damage any single biased decision can do.
So it's not really a one-and-done thing, is it? It's more like ongoing mental maintenance.
Exactly. It's a continuous process. Self-awareness, reflection, committing to making rational choices that align with your long-term goals.
So the big message here is,
Yeah.
understanding our own psychology, our biases, is absolutely fundamental for making good financial decisions and actually building wealth over time.
Couldn't say it better. It's not just about the numbers. It's about how our minds interact with them, often irrationally.
Recognizing those hidden influences gives you back some control.
Empowers you to make choices that really serve you in the long run.
So maybe as you're thinking about all this, just consider, which bias resonates most with you? Where might it be showing up?
Yeah, a little self-reflection.
And maybe more importantly, what's one small, concrete step you could take, maybe even today, to bring a bit more objectivity, a bit more awareness into how you handle your finances? Definitely something to think about.